Over a month past the deadline to release quarterly financial statements, we have what may be considered to be the full set of listed companies that provided financial statements for the quarter ended September 2020. This comprises 4,234 companies. This full set tells us the same story that we gleaned from a smaller set 2 months ago, which is that listed companies have made their highest ever profits in the midst of a severe lockdown. They did so by cutting costs a lot more sharply than they suffered the fall in sales because of the lockdown. The cost cutting was essentially in raw material and other operating costs, enabled largely by favorable terms of trade for manufacturing companies. Total income declined by 6.9%. But costs on raw materials and purchase of finished goods, the biggest expense, had declined by a much bigger 18.9%. Expenses on salaries grew by 3.4% and other expenses fell by 9%. Net profit increased by 568.5%. Year-on-year growth in profits is volatile. In the recent past, it has varied from -98% in the March 2018 quarter to 356% in the March 2019 quarter, and down again to -90% in the September 2019 quarter. Even by these standards, a 569% increase in profits is extraordinary. Much of this can be explained by the extraordinarily low base of telecom companies in the previous year. Wages account for a relatively small proportion of the total expenses of corporates in India. Its average share before the lockdown was 10%, with a range of 7.5–13% in the past 15 years. As a result, the small 3.4% increase in the wage bill during the September 2020 quarter did not have a significant bearing on the overall growth in profits. However, what is worth noting and is somewhat intriguing is that firms considered it fit to cut and substantially contain their wage bill, although they were making huge profits in the quarter. A cut in the wage bill could mean a combination of layoffs and wage rate cuts. It is likely that the wage bill was contained largely through a cut in the wage rates for the permanent staff rather than a slashing of headcount of permanent staff.